Hi, I'm Jeff Jonas, Portfolio Manager of the Gabelli Healthcare and Wellness Trust. Like all sectors of the economy, healthcare has seen significant disruption from the COVID-19 pandemic. However, given the essential nature of healthcare services and the traditional defensiveness of the industry, healthcare stocks are down much less than the broader market. In March, as the scope of the pandemic became clear, consumers stocked up on prescription and over-the-counter medications. Drug makers such as Pfizer and Eli Lilly still expect to meet their guidance for the year, although they have seen some disruption in their business. Clinical trials are delayed, new drug launches are going slowly, and new patients are late to start prescription drug therapy. Wholesalers such as AmerisourceBergen and McKesson continue to operate smoothly, moving medicine from the manufacturer to our retail and mail-order pharmacies. The pharmacies, including CVS and Walgreens, saw significant stocking activity in March as consumers rushed to buy product in the front of the store and in the pharmacy. Same-store sales were up over 20% in March, but reversed to sharp declines in April as lockdowns took hold and as consumers worked through their inventories. These businesses will reopen as the economy does, but may not see the same level of traffic and sales as they did pre-crisis. Our hospitals, including HCA and Tenet, have seen the biggest disruption from COVID-19. In mid-March, they were forced to stop all non-emergency surgeries as they prepared for a swarm of COVID-19 patients. These surgeries drove a significant portion of hospital revenue and cash flow and have had a negative financial impact on the companies. COVID-19 patients, given the extreme safety precautions that need to be taken, tend to be very low-margin hospital stays for these companies. Thankfully, the federal government has responded with over $175 billion in aid to the industry through the CARES Act. This will take the form of grants, low-interest loans, and accelerated payments to help the balance sheet of our nation's hospitals. The medical device companies who supply hospitals, including Medtronic and Zimmer Biomet, are also seeing significant disruption. Their procedure volumes were down high single digits in the March quarter and could be down as much as 70% in the June quarter, depending on the line of business. However, hospitals, surgeons, and outpatient surgery centers are prepared to work nights and weekends in the second half of the year to clear the backlog of delayed and deferred procedures. Our insurance companies, including UnitedHealth and Cigna, could actually benefit from the COVID-19 crisis. The savings from these deferred or canceled procedures are likely to far outweigh the cost of COVID-19 patients. They will pay rebates to employers and government payers where appropriate, but overall their earnings should hold up just fine. Later in the year, though, they are worried about a negative mix shift as employment drops and as people shift to low-margin Medicaid programs. So overall, the healthcare industry has seen significant disruption, but it's also been incredibly flexible and resilient. We continue to find strong investment opportunities and look forward to the recovery in the second half of the year. Thank you.